Hello everyone, and welcome to episode 2 of the accounting series. There is a man named Bob who started his own software company by investing $100,000. Now he needs employees to run the company. He hired some employees who demand a salary of $30,000, and Bob is comfortable with that. Now Bob went to a dealer to buy some products worth $20,000 for his company on credit, and the dealer agreed to this due to the large deal. Now Bob has set up everything. He just needs clients. He is very worried about getting clients. Luckily, he gets his first client who needs software for their business. Bob asks about the size of the deal, and the client replies that it is worth $150,000. Hearing about this huge deal, Bob immediately accepts it. Now Bob is confused about how he should record all these transactions properly for a good future. He calls his friend Nick, who is a famous accountant. Nick agrees to solve his problem. Now let us see how Nick solves the problem and explains some important concepts along the way. Hello there. Before learning how to record transactions, you need to understand the 3 golden rules of accounting. 1. Personal account. Debit the receiver, credit the giver. Personal accounts involve individual persons or entities. Example, paid $10,000 to Mr. Sharma. Here, Mr. Sharma is the receiver and you are the giver. 2. Real account. Debit what comes in, credit what goes out. Real accounts relate to assets such as land, buildings, cash, etc. Example, purchase of land or receipt of cash. 3. Nominal account. Debit expenses or losses, credit incomes or gains. Nominal accounts relate to expenses, losses, incomes and gains. Example, paid office rent, 15,000 rupees. A T account gets its name from its shape, which looks like the letter T. The left side of a T account is called the debit side, and the right side is called the credit side. We know the basic accounting equation. Assets equals liabilities plus equity. Let us now see how each type of account affects a T account. Starting with asset account. When an asset increases, it is debited. When an asset decreases, it is credited. This treatment follows the real account rule from the 3 golden rules of accounting: debit what comes in, credit what goes out. A liability account is credited when it increases and debited when it decreases. A liability account follows the personal account golden rule. This is because liabilities represent obligations or amounts payable by the business. When a liability increases, the business owes more, so it is credited. When a liability decreases, the obligation is reduced, so it is debited. An equity account also follows same rule. It is credited when it increases and debited when it decreases. Equity represents the owner's claim on the business. When the owner invests more capital, equity increases and is credited. When the owner withdraws money or capital is reduced, equity decreases and is debited. Here, you need to know one important thing. Revenues and expenses affect equity. We will learn this in detail in future. For now, you only need to understand that expense and revenue accounts follow the nominal account rule. When revenue increases, it is credited because it represents income earned by the business. When revenue decreases, it is debited. On the other hand, when an expense increases, it is debited because it reduces the business's profit. When an expense decreases, it is credited. Revenues increase the owner's equity because they add to the profit of the business. Expenses decrease equity because they reduce the profit. Journal entries are used to record financial transactions and events in a company's accounting records. Example, buying raw materials with cash on January 1st, 2026. Here, accounting follows the double-entry bookkeeping system, which means that every transaction affects at least 2 accounts. One is debited and the other is credited. In this transaction, raw materials come under inventory, which is an asset account. Since inventory is increasing, it must be debited. The purchase is made using cash, which is also an asset account. Since cash is decreasing, it must be credited. While recording journal entries, we generally write the debit account first, followed by the credit account, like inventory account to cash account. Now, let us go back to our example. In Bob's story, 4 transactions have occurred. First, Bob invested $100,000 into his software company. Second, Bob paid $30,000 as employee salaries. Third, Bob purchased products worth $20,000 on credit for the business. Fourth, Bob entered into a deal with a client for $150,000 to develop software. It is also important to note that Bob's company, Innovatech, follows the double-entry bookkeeping system and uses the accrual method of accounting. Now let us see how we record each transaction. We start with the first column as the date. In this example, we are not mentioning specific dates. The second column is the account name, followed by the debit and credit columns. For the first transaction, Bob invested $100,000 in the business. This transaction affects the cash account and the equity capital account. We know that when cash increases, it is debited. Equity increases when the owner invests money, so it is credited. For the second transaction, Bob paid $30,000 as salaries. This transaction affects the salary expense account and the cash account. Salary expense is debited because it comes under an expense account and expenses increase on the debit side. Cash is credited because cash is decreasing. For the third transaction, Bob purchased products worth $20,000 on credit. This transaction affects the property, plant and equipment account and the accounts payable account. PP&E is an asset account, and since the asset is increasing, it is debited. Accounts payable is a liability account, and when a liability increases, it is credited. For the fourth transaction, Bob entered into a deal with a client worth $150,000. Since the company follows the accrual method of accounting, revenue is recorded when it is earned, not when cash is received. This transaction affects the accounts receivable account and the sales revenue account. Accounts receivable is an asset account, and because the business now has the right to receive money from the client, the asset is increasing, so it is debited. Sales revenue is a revenue account, and when revenue increases, it is credited.